Class is now starting. All attendees are in listen-only mode.
Hey everyone, thanks for joining us today. Welcome to Trend Following Investment Strategies with GoNoGo Charts. Today we've got Tyler Wood and Alex Cole. Tyler, of course, is Managing Director of the CMT, an organization very close to name. We have great reciprocal relationship with these guys. You'll see us at their conferences, they'll be at our conferences. Great relationship a long term with those guys. I'm Ryan Redfern, current VP of NAME. I'm really looking forward to today's presentation. Of course, first of all, what is NAME? If you're new to us, NAME is an organization for investment professionals. So RIAs, money managers, advisors who believe in actively managing market risks for their clients. It's a great resource for all things you need to run your successful advisory business, whether that be compliance, technology, just a place to bounce ideas. A lot of knowledge in the membership, and NAME is the place to do it. In addition to having monthly webinars like this one, we also have the NAME Exchange, which is a peer-to-peer virtual happy hour, and it's an open discussion. And that happens the last Thursday of each month after the market close. So next Thursday, be there for that if you're a member. In addition to having monthly webinars like I said the part, we're going to have a live 2-day Outlook conference. We are going back in person. We're getting the band back together. See, we brought our instruments today. We're getting the band back together, having our conference in Chicago on October 11th and 12th. That will be limiting attendance to 50 people. This event will sell out. So please sign up at name.org. We hope to see you in October. In addition, we are currently taking applications for the NAME Active Investment Strategy Competition. Finals for that will be June 23rd, 24th. That's soon. Coming up quick. Winners and just have raised over 250 million in assets by distributors for these things. So if you're a money manager, you have a good strategy, you want to be in front of these people who can get you out into the public. So it's worth doing. Susan is attaching information about this competition in the handouts, I believe, and can also be found at name.org, and you can also email one of us. Replays of this event will be available to members only or participants here today. So that's, if you're here, you're all good. Along with the entire webinar series, if you're an investment professional, it's good stuff, good history. All right, so today's presentation counts towards 1 hour of continuing education for CFP holders. So anybody here today is a CFP holder, contact us. You can get hour of CE credit for it. Questions. If you have questions for Tyler or Alex during the webinar, please type them into the questions panel as close to the bottom of the control panel on the right, and we will address them at the Q&A section following the presentation. All right, I'm going to shut up now. Let's get to it. Tyler, Alex, good to see you guys.
Hey, great to see you as well, Ryan. Thanks so much for having us. And good afternoon to everybody at NAME. I have gotten to know the board of directors, the members, and the folks through years of NAME conferences, and really appreciate the fact that every single member of NAME actually manages money. And there's a difference between talking about the markets and actually having to invest on behalf of clients. So I can appreciate that we might see more people join in as the markets wrap up today. But I just wanted to start out with the headline, because what I have found with the CMT Association being part of NAME's conferences and having NAME members come to our symposiums and webinars in the past is that most of you have a lot on your plate, right? You're dealing with client relationships. You're thinking about the entire financial plan for your clients. You're thinking about who's getting divorced or going to college or major life events. You're also worried about compliance. Heard some really helpful, fascinating, and perhaps scary discussions with the folks who understand the compliance side of financial management. And then, of course, you're running your business. So you've got marketing and growth targets. You're trying to raise assets and expand your own investment advisory business. So the analytics portion to managing the money is just one of the many hats that you wear. And the last thing that you need is somebody to share with you how many more squiggly lines you could look at on a chart that would tell you some derivative information on price. That's not what we're going to do today. And in fact, in my chair at the CMT Association, I've gotten to see over the last decade some of the most sophisticated tools on the planet for long-short equity managers, hedge funds, the algorithmic, systematic trading, market makers who are doing high-frequency work. And I will tell you that the discipline of technical analysis continues to advance. And there are new ways that people are expressing these ideas. But the core concept what we're trying to understand about why markets trend, what levels have importance in people's minds, is really based on human psychology, which has evolved over thousands of years. We've brought all of these cognitive biases and heuristics. We could spend the whole day talking about behavioral finance and why markets do trend, why they are not perfectly random. But when Alex Cole and I first met over a decade ago, he was in charge of teaching all of the new hires at Bloomberg, as well as Bloomberg clients, about technical analysis. And through that experience, he developed some very, very helpful, elegantly simplistic tools that bring together a full technical picture. They're called the GoNoGo Charts. It's about as simple as that: go or no go. So what we're going to do today is talk a little bit about the philosophy and the practice behind all these technical tools, why people were developing these indicators over the last 60 years or so, and then how you could consolidate those into a clearer picture to really focus on price action, trend. And for those of you who are actively managing money, we're going to talk about a number of other elements to technical analysis that will really help you understand the context, what regime we are in, and how you might want to think about position sizing and understanding where you've got exposure for your clients across all asset classes and time frames. So this isn't one particular style of investing practice. It's an idea about the general concepts of technical analysis. So thank you very much for being with us this afternoon. I'm going to have Alex kind of walk you through a little bit about the tools that he has developed and his experience within Bloomberg, starting with trend analysis and why trend is so important. Then we'll talk a little bit about oscillators, some derivative indicators that understand momentum, and then we'll wrap it up with some questions and some live examples. So if that sounds good to everybody else, let's kick it off, Alex. Let's talk a little bit about markets that trend.
Thank you very much, sir. So thanks again, everybody, for having us, and it's a pleasure to be on the call. I think that the key takeaway for me from working with institutional clients at Bloomberg for, I think it was 13 years in the end, was that we all overcomplicate our process. And so we know that what we've studied, and we know that what we've learned, and we know that what we look at has value. But as Tyler said, the problem becomes a chart that has 30 lines on it, 10 panels, and it becomes very difficult to sort of even read what it is you've put on there, even if you are a sophisticated technician. And so the goal for the GoNoGo charts, or the goal for really this kind of analysis, is to take the fundamental concepts of technical analysis along with some of the most robust, sort of statistically measured ideas, and blend them together to create a chart that stays simple enough for price to remain the focus. So given that that's the goal of our technical analysis, we're going to, if you can just go back to that last slide just for a second, Tyler. We're going to start by trying to identify the trend, right? So, and that's the most important skill. We can do whatever we want to do outside of that, look at derivatives of price, look at other things, but the price trend, the direction of price, is arguably the most important thing that we can search for. And if we can do that, then we can profit on the majority of the move. Mm-hmm. And we like to say that it's a simple idea. It's, buy low, or even buy high, as a technician would say, buy on one side of the chart and then sell later on when you've made money on the move. And it's not hard. It's sort of simple, but it is hard, I should say. And what we want to go on to now, if we go to the next slide, is the idea that we can build a process. And so one of the things that we'll do is we'll look for, every technician will get into this a little bit more. We'll have a checklist of things that they look for. So in this case, we might start with just the simple visual of looking for higher highs and higher lows. And we can generally say if there's a discernible move from bottom left to top right, then we're in a trend. And then we'll try to find an indicator that automates that process. And there's a few that'll do it. And one of the most commonly used and most most famous, I guess, if anybody's familiar with the idea of the turtle traders, or that story of Richard Dennis creating traders the way they created turtles at farms when he was on his travels. The Donchian channels is something that tracks new highs and lows based on a set period. And so you can see that it will then show you these higher highs and higher lows. The red line above is tracking the highs, the green line below is tracking the lows. So over a set period, it'll look back and say, is the price right now a high for the period? And if it is, that red line will move up to match it. And so you can get a sense, and here we've annotated the red arrow in the middle of the chart roughly, where that first new high was made. And this could be sort of your first indication that a trend is forming, or a trend is taking shape in that direction. And then when we move on from this, almost everybody that I work with, even people that did not consider themselves technical or have any kind of technical background, would have moving averages on their chart. In fact, when we were designing product, we were talking about usage at Bloomberg, we wouldn't even consider people who used moving averages as technical analysts or power users of the technical charts. It's so commonplace. It's just a charting functionality. And I would talk to people all the time, say, yeah, I don't do that technical analysis. And then I would look at their chart and they'd have a moving average on it. You know, it's that pervasive in our industry. And it does a really good job of smoothing price action. It highlights the underlying trend. And the quote on here is from Paul Tudor Jones, who said that his metric for everything is the 200-day moving average of closing prices, because it really does, especially in that longer time frame, it pulls out the market movement. And so if we then look at this is the example that we had at that original slide. On this, we've thrown a 60-period moving average on, and you can see that right a little bit after, or right as that Donchian channel was suggesting a new high, prices gapped up and jumped above the moving average, and actually comes back and retests it. And so we can now, we're adding sort of weight to the argument that we're making that there is perhaps a new trend forming. Now, some people will look at the price interacting with the moving average. Some people will look at the moving average change, the slope of the moving average as well. That's obviously a little bit more conservative. It happens later in the chart where that average turns up. But around the same sort of area, we can sort of see a new high. We're seeing price jump above the moving average and then find support there. And so we're starting to put these things together and say, yes, we're starting to identify a new trend. You know, from there, you might then add something that I really, really like, simple price momentum. I know it's really basic, and as Tyler said, some people that get incredibly sophisticated and some really advanced concepts out there. But just the idea of whether or not price now is higher than price was a certain period ago, just in its simplicity has a lot of value. You can almost say if price is higher now than it was, then we're in an uptrend. You know, it's as simple as that. And we joke about this quote that it's on here that I can't remember how long ago now this was, but during 2020, when everybody started trading, you know, it wasn't just financial professionals anymore. It was Uncle John and your brother-in-law and everybody jumping into the markets and thinking that they just go up. Somebody showed me a TikTok of a young couple who'd quit their jobs to trade the markets, and they sort of had this reveal where they said, all right, now my husband's going to tell you how we do it. What's our strategy? And he said, well, I buy when the line's going up, and then I stop buying when it's not going up anymore. And it's hilarious to think about it, but in a way, that's how simple technical analysis, and that's the beauty of the visual nature of technical analysis. And we need to try to remember that it is a simple but not easy task. We need to find securities that are trending and that are strong. And so buying securities that are making highs and then selling them later on is buying strength. If that line is going up, the trend is still in place. And we'll see that more with relative strength as well later on. But that's always something that we chuckle about with the TikTok, the TikTok video that everybody was investing. I think there's a TikTok investing group. Like there's a thing for TikTok investment. So incredible year we've been in since last March.
It's only when the tide goes out that you find out who's been swimming naked. And I'm sure name advisors know all too well how many clients think anybody could do this. Well, of course, when the market's going straight up. Sorry, Alex, I'll let you keep going.
That's all right. I mean, even today, right, with what a shakeout we've seen in Bitcoin, we're back up close to 40,000.
Yep.
Touched around 30,000. Some scary moves today.
Big moves.
Anyway, so then you can move on then from then and continue to build your case for whether or not we're in a trend. And one of the concepts that I like, and I've always found a lot of value in is the idea of using momentum oscillators for trend. And that's a bit counterintuitive because they were designed for sideways markets or for swinging markets to identify peaks and troughs and to see when the velocity of price movement had gone perhaps too quickly in one direction, and then you would bet against it bet on it coming back, some sort of a mean reversion idea. But people like Connie Brown did a lot of work on trying to understand whether these indicators that are so well used, I mean, RSI, after moving averages, RSI has got to be the most used indicator that there is. So how can we pull value from this momentum indicator even though we're in a trend? And what we end up talking about, or what we read about, was the idea of ranges for these momentum oscillators. So bull market ranges, bear market ranges. So in the case of RSI, the research is out there and the studies have been done that generally speaking, in a bull market, a security will go overbought and then it'll come back, and it'll go overbought again and it'll come back, because that's a good sign. There should be heavy buying when there's something good to shout about for the company. It's not a bad thing if everybody's buying Apple because the iPhone 13 is going to be fantastic, let's say. So you'd expect in an uptrend excessive buying. What you don't expect in an uptrend is excessive selling as well. The swing from overbought to oversold is unlikely to happen in a solid directional move. So they found that instead of looking at RSI going from 70 to 30, which are your traditional levels of overbought and oversold, they found that in bull markets, an RSI might range from 80 as a top to about 40, never quite getting to that oversold territory. And some people will change that. They'll use 75-25 depending on the asset or depending on the security. And it's a great idea, and it's something that stuck with me for a long time. But it's quite subjective, because if you know RSI or if you know stochastics, you know any of these oscillators, they're very fast moving and very choppy. So for one security, you might find that range is really 38 or 43 seems to be where it finds support. Mm-hmm. Some people will look at just crossing above and below 50 to keep it simple, but it's a subjective process for each security and for each asset of finding those ranges. And in a bear market, the argument would be that it falls to about 20 oversold, and on those correction counter trend rallies, it'll come up to, let's say, 60, but it shouldn't go overbought. Again, that would be a concern for the downtrend. So using that kind of idea on that example, we found that it was being supported by about 40. And then we could move on and sort of talk about volume as well, volume being the first piece of new information that everybody will look at, right? So you've got these indicators that are derivatives of price, or they're calculated off price. Price is paramount. That's so important. And then the first piece of new information that people will generally look at is volume. And on this example that we're looking at, again, that gap in price that triggered the Donchian channels, that caused price to jump above its moving average, that was where the RSI found support. And now we're seeing high volume as well, confirming that move, right? So volume is confirmatory, reflects participation in the market. And so we can put it all together, and we can now have a chart where we can be fairly confident that there has been a technical environment change. So we were moving down, we were making lower lows, and now right about a third to, almost halfway through the chart, we can be fairly confident that the environment has changed. Now, that doesn't mean necessarily 100% we're going to go into a strong uptrend, but that downtrend that we were in, or that prior environment, has changed. We've got a new high. We've got prices above the moving average. We've got the momentum indicator above zero. I'm gonna rename it the TikTok indicator above zero. We've got the RSI finding support at 40, and we've got volume confirming. And then even a little bit later on, that slope of moving average also confirms by turning up. So we've got all of this information that's allowing us to feel fairly confident that, okay, the trend is now in place, and we could look to take a position. But the good thing is that confluence of signals gives us conviction. But the bad thing is that the chart, even in this case, and this is a relatively simple example that we walked through, it makes it hard to read. It's a simple process, only 4 or 5 steps, but the chart is hard to read, and we can't anymore see price. Price becomes shrunk into a small panel in the top. There's lines all over price, And again, this is a fairly straightforward example, but it becomes harder to do the basic price analysis. It becomes hard to find trend lines. It becomes hard to look at key levels, like Tyler was talking about with, investor psychology anchoring to certain prices. It becomes hard to find those levels, and it becomes hard to look at patterns. And we've all talked in CMT conferences and everything about the old stuff still works, right? Like Edwards McGee, 1941, that book, read it. It's brilliant. And the market dynamics of supply and demand play out on the chart. And if you can find a triangle, you've got buyers and sellers competing, and sellers being, depending on the kind of triangle, you could suggest that buyers are being more aggressive by setting higher lows, and you're going to expect a break above the horizontal bound of the triangle. So all that kind of analysis becomes very difficult to do.
I was a little late. Poor Ryan and Susan were perhaps a little worried that I was going to make it this afternoon. We just finished recording the June podcast for the CMT Association with Ralph Akampora. And I'll make sure to send that to Susan so everybody at NAME can have a listen as well. But Ralph told a story when he first got to Knight Capital Group right after he had left Prudential, and he walked around the trading floor, and at that point he'd already been 40 years in the business, and talking to some of the young traders who had 7 vertical monitors and a chart with 1,000 lines on it. And Ralph said, "Wow, I've been doing this a long time, but son, can you tell me what all are you looking at? I haven't seen a chart like that." And he said, "Ralph, I have no idea what any of this means. It's just when the boss walks by my desk, he thinks I'm really busy and super productive. So I just put more and more lines on the chart, and he thinks I'm a genius." And I think that technical analysts have done themselves a disservice. And we talk about this a lot as an organization and with the members, that either through jargon or through just complexity, creating complexity does not help your end user. So for money managers, right, talking to the audience at NAME, we really want to emphasize that even in that simple 4-part process, having that confluence of signals is really important, but it's already gotten complex. Alex and I love a lot of great investor quotes, but here's one for you from Mark Abraham. He says, "Ultimately, it is the dollar-weighted collective opinion of all market participants that determines whether a stock goes up or down. It's this consensus that is revealed by analyzing price." And I think that that's at the core, talking with the folks who've been doing this for so long. It is not about derivative indicators. It is not about a more complex process, but rather really understanding that price represents this collective opinion of buyers and sellers. And there's nuance to all of it. We would never tell you what time frame or which asset class you should be trading, but because technical analysis should work across all of the above.
And I just to jump in there, sorry Tyler to interrupt. The number of times that I built relationships with people over the years that I would continually work with when Bloomberg users or even since then, and you could sort of, let's say in the initial stages of them becoming an analyst, let's say a sell-side research analyst, I'd help them build charts, and we'd build out these charts, and they'd do all the learning and the research, and then they'd start distributing that to their buy-side clients, and they'd be sort of saying, okay, here's where we're starting to get bullish because of this and this and this and this and this and this. Mm-hmm. Over the number of times, I can't tell you the number of times over the years, that chart goes back to basics. Over the years, it goes from the chart that they start with in their first year or two of learning. Maybe it gets more and more complicated the first 2-3 years, and then years 5, 6, 7, 8, they start taking stuff off the chart, and it goes back to we're bullish here because as long as price stays above the prior high. Something maybe even as simple as that. We're bullish as long as price is above 200 because of XYZ. And they'll have their other charts still that they refer to, but they're stripping it away, and especially for ease of understanding and explaining to clients. Mm-hmm. A lot of so many times the people's technical analysis life sort of goes more and more and more complicated, and then finally starts to get a bit more simple. So
that's right.
Absolutely.
This from the guy who's getting a fresh puppy delivered on Sunday. I don't know if you really believe in simplification, my friend.
I'm trying to keep the charting simple, and then the rest of your, everything else can go crazy.
After a year of homeschooling children and no travel and home office work, I'm sure everybody on the line right now can relate to the need to simplify. All right, so we've talked a little bit about very basic concepts for understanding trend. Let's put this into context with money managers. And I want to share a story with you that comes from Dave Keller, who was a past president of the CMT Association. At the time that he shared this, he was the director of research at Fidelity Investments in Boston. He was also an amateur pilot. And I'm sure many of you sail boats or maybe even fly your own plane. The first thing you do is you spend a lot of time on the ground before you ever get the plane in the air, and the flight instructor trains you to be very checklist oriented. Because when you get up into the air and they just cut the engines and you feel the plane lurch forward, nose down, it's a panic-inducing feeling. And I'm going to venture to guess that for everybody in the room today, that last February was a gut-wrenching feeling. The markets, the speed at which we made it to bear market territory in February of 2020 and through to the March lows was just shocking. There's no other word for it. And it does induce panic for anybody who is not prepared for that outcome. Now, when Dave talks about flying, he's like, could be as simple as you knocked the fuel shutoff valve with your knee, right? Is your ignition cut off? It might be a more complicated problem, but it could be something very simple. So you use a checklist. You prepare for the inevitable to make sure that you are not reacting emotionally, but just going through your process. And the same thing applies to investing. For rules-based, trend-following investors, they might have a checklist of items that they're looking for to assess risk and reward, to see if, is this feeling frothy? Are we approaching a top? Is the regime about to shift? And if so, what are my risk management principles? I'm going to share one more with you all. A very successful money manager from Boston who talks about the inviolable rules of trend following. My co-host on Fill the Gap podcast, Dave Lundgren, who has been doing this for many, many years, he's never taken a loss that has, let's say, ended his career or sent him out of a firm or closed down his fund because of his risk management principles. Now, for Dave, these are going to be different for every investor, but for him, he simplified it to 4 things. Now, of course, fundamentals are driving these long-term trends, but when he thinks about his checklist for a trend change, it really boils down to these 4 things. There is a break of the trend line. Price breaks below that moving average line. You violate the last important high or low, the swing high of the period. The 50-day moving average crosses below the 200-day, or the short period crosses below the long period moving average. And then you're talking also about the slope of those moving averages, and that's where you would have to get out, right? There are no more buyers. We are now prepared to enter a downtrend. And the same thing in reverse. I won't belabor the point, but you saw from what Alex was talking about before, there are a lot of technical tools out there to assess trend. Now, you can add more and more lines to your chart. You can look at derivative indicators. You can create some of those tools in your charts to help you assess your own risk management, to help you set your stops based on a defined rules set. That's very good risk management, and it is important to have that system in place before you ever get to a February 2020 or before the flight instructor turns off the engine, because you don't want to be reacting emotionally in that moment on behalf of your clients or yourself. But what if you could have all of those checklist items without overcomplicating the piece that you're looking at? What if you could still see price and focus on what is most important? So in this next section, we're going to talk a little bit about the rest of the technical toolkit, providing context, comparing across multiple time frames and across asset classes. We're going to talk a little bit about relative strength versus just an absolute trend. And then we're going to talk about the overall environment for risk, each of which Alex has built into the GoNoGo Charts toolkit. So stick with us. Let's talk first a little bit about multiple time frames. This obviously comes 130 years ago from our friend Charles Dow, who was discussing in nautical terminology the waves of investors, and that the primary trend, which could extend over multiple years, even decades, is like the tides of the ocean. That is driven by fundamentals. The long-term trend is the most steady. It's the hardest to shift. When that changes and you have a major regime shift, you're going to see that in the economy. It's not just a market reaction to news. That's the primary trend. But he said, along with the tides, you also have the waves of the ocean. And that's the investor public's reaction to the news about the fundamentals. And that secondary trend, where a lot of technicians, a lot of trend followers find a lot of value, this is where they make most of their money, is understanding that human emotion is going to drive investors into a herding principle. You're going to see price momentum. There's a lot to take advantage of on that secondary time frame. That's weeks to months, and I'm speaking in broad terms just for the sake of argument. And then that third time frame, which Charles Dow characterized as the ripples across the surface of the water. It's very fickle. You might see a very fast move, and particularly these days, what we're seeing right now in cryptocurrencies could be a good shakeout of a lot of retail investors so that bigger shops can get involved. And certainly when we look at market makers on a very short time frame, we're talking high frequency trading, that is what it is entirely designed to do. They could care less what the security is or any fundamental factors. It's all technical and it's all based on behavior. All right, so we've talked about multiple time frame analysis. We're going to go into some live examples here at the end and talk about how you could look for entry, position sizing, and exits using GoNoGo charts. But let's talk about the next side of what technical analysis can do for you, particularly when we've been in this high rotation, choppy market. I love the phrase, when in doubt, zoom out. There's been there's a pretty hated bull market, I would say. A lot of analysts talking about inflation risk. We've heard a lot of folks saying, that this is unsustainable. It's very frothy. Look at all the NFTs. There's no way that this could continue. So if we just think for a second about comparing, across asset classes, looking at those trend identifications. So thinking about all of those tools that we looked through at the beginning, just exercising a simple color to tell you when something is in trend or out of trend, you could apply that to something called a heat map and look at across asset classes to see what is trending and what is not. So Alex, why don't you tell us a little bit about the GoNoGo heat map that we're looking at right now?
Yeah, it's like Tyler said, it's just the application of the idea of trend identification to, a heat map. We're calling it a map panel, but the panel's below price. So what that allows you to do is just forget about price movement at all. Just what is the trend? And using that blended set of statistical measures and concepts of technical analysis, what is the trend across the assets? And so looking at this is a 5-panel map that we built using equities, treasuries, commodities, the dollar index, and digital assets. We can see that the equity trend has been in place and is still in a go. The go colors, remember, are the blue colors, the bright blue and the aqua. The no-go colors are the purple and pinks. So bearish conditions, purple and pinks, blue and aqua, go colors. And then the amber bars that you see in there are what Tyler came up with this. We're calling them go fish bars because one of his quotes that he loves is a Jesse Livermore quote that is, there's a time to go long, time to go short, and a time to go fishing. So when the market's not telling you anything directionally, then we'll paint the bars amber, and that often happens as a bridge between trends as well. But you can see that equities has been in a go trend for the whole period of this chart, bar a couple of amber go fish stripes in the middle there. Mm-hmm. Treasuries mostly a no-go. Briefly flirted with the idea of trying to get a go trend going, couldn't sustain it, and have fallen back into no-go. But that makes sense.
A quick word, we're looking at treasury prices, not yields. So in
Yep.
this May period where we saw things actually cooling off, yields dropping, prices rising, now we're steadily back into a no-go, but certainly not at the velocity that we were at earlier this year that was spooking the equity markets.
Yeah, and it's just so you know, we're using the IEF, the Treasury fund for that. But yeah, and you know, you intermarket analysis. I don't know if you, it's such a linchpin of technical analysis. You know, some of the
John Murphy.
John Murphy's text, the intermarket analysis book, is used in all the has always been used in our readings and the exams, and it's people think technical analysis sometimes. I mean, not everybody, but often you come against the idea that people think technical analysis is day trading.
Right. Right.
It really isn't. It really isn't. It's a really much larger part of understanding the markets as a whole and an intermarket analysis. So, you know, a strong trend in equities, you know, makes sense that would then correspond with a bearish move in Treasury bond prices, risk on versus risk off. The third panel we've got there is commodities. Again, commodities have been in a very strong, overall a strong go trend. The fourth panel is the dollar index, and we've been really interested in this dollar chart for the last year or so. Very strong downtrend on the larger weekly time frame, mostly strong no-go trend on the daily as well. And then in the last month or so, the dollar really had a little rally and attempted to break out of that, but has fallen back now into a fairly strong no-go trend over the last couple of weeks to a month. And then the lowest panel there is Bitcoin. Bitcoin has been bright blue for about 2 years, maybe, I don't know, whatever. And then you see those no-go bars creeping in, and now solidly no-go for the last sort of week to 10 days. So just, and this is where we talk to a lot of money managers about asset allocation and about, you know, obviously people have different strategies, different criteria that they can follow and different investment strategies. But getting that macro view is something that you can do when you just assess the trends that are going on globally.
All right, so let's switch gears. I know everyone at NAME understands relative strength. We're looking for things that are trending and outperforming. We want to own the best stocks in the marketplace, or the best securities across assets. But in case this gets posted to YouTube and somebody else, let's just do a quick review. Relative strength is simply the ratio of price. In this example, we're going to look at gold and the S&P index. And I think it's a great illustration, good case study going into the collapse in the COVID crisis, February and March of 2020. And so the bottom line that you're going to see in green, let me see if I can get a cursor over there. We are looking at that relative ratio where, of course, gold and equities were falling throughout that period. There was a high correlation across all assets. But relative to equities, gold was outperforming in a significant way. You would have lost a lot less had your portfolio been heavy weighted gold versus equities during that period. And then you can obviously see as time went on, equities outperformed gold on a relative basis and an absolute basis. So when we're thinking about our process and our tools, long-term money management, we want to own things that are trending and outperforming. It's going to give us the highest probability of success. And there are 1,000 white papers out there where we've got experts who have tested this out and back tested and forward tested for years. So we know that trending and outperforming stocks are what we want to own. So on a relative basis, right, owning gold as a flight to safety trade throughout the COVID crash made sense. But on a relative basis, equities began to outperform gold as we got into that stay-at-home trade where stimulus money came out through the fall. Equities are ripping higher and significantly outpaced gold. So if we use a GoNoGo chart, you can see where the trend was solid enough to establish that long-term outperformance for equities versus gold. And now let's think about the next step. All right, so great. Equities are outperforming precious metals. We're going to let go the safe haven asset trade. We're going to stop holding all treasuries and cash and gold. But where in the equity space do we want to own? Well, throughout last year, it was all growth stocks. It was the stay-at-home trade. It was owning technology companies that were going to revolutionize how all of us were going to live and work in a world where we couldn't go outside and couldn't talk to our neighbors and couldn't go shopping without masks and gloves and all of the rest of it. So you saw the XLK, that's the tech sector ETF, significantly outperforming the broad index, right? Again, just a relative ratio, relative performance of that sector versus the index. Now we've seen that sort of trail off in recent months. While we've had the reopening themes, while we've had this rotation from growth sectors to cyclicals, we're obviously seeing financials, energy, industrials, materials start to outperform, not just on an absolute basis, but also on a relative basis. So Alex and I just wanted you guys to see this chart of the XLF versus the XLK. So financials versus technology. Now, did you want to own banks or did you want to own Google throughout most of 2020? I'd go with Google. But into 2021, the second year of this bull market, we're looking at a lot more cyclical sectors leading. We're seeing the industrialized economy coming back into sort of the foresight of the market. The market's always looking 3 to 6 months out for where the economy is going to be, and those are the sectors that have been outperforming. So capturing the trend, not just on an absolute basis, but also on a relative basis, is going to help us outperform over time. Again, these are weekly, longer-term charts on a relative basis. All right, but Alex, we don't want to go through every single security comparing against that would be an endless task, analysis paralysis. What if I wanted a quick glance across all of the sectors or against a basket of securities? Maybe I'm doing some tactical asset allocation work and I just want to get my sector bet right. Maybe I want to construct some portfolios that are overweight those leading sectors. Maybe that they need to be underweight the laggards, and maybe we want to construct something on behalf of clients that we could do more quickly. Tell us a little bit about the GoNoGo rel map.
The rel map's the same idea, same concept as the map we looked at with the asset classes, but instead of just a pure trend-based map, we're coloring these panels based on the ratios of the securities that are in the panels to a base. So in this case, this is a sector rel map. We've got the 10 sectors. We left off real estate, but we've got the 10 sectors of the S&P relative to the S&P itself. So in that chart we just looked at, where we had XLK and XLF, like the technology to financials, that's one of these panels. And forget the price movement, just what is the trend of that ratio. And so you can really start to see how allocating toward the leading sectors versus the lagging sectors it gives you some real edge there. Because if you looked at this chart throughout 2020, let's say, they'd all be blue, right? All the equity sectors would all be blue. From end of March, probably throughout the rest of the year. Every sector, all equities, great strong rally off the lows, those pandemic lows. So
on an absolute basis,
on an absolute basis,
sector's trending. Yeah,
you could look at a map that showed all the panels for the sectors, and it would all be blue. So yeah, well done, you're in equities. But if we go a little deeper, which is what you're suggesting when you talked about tactical asset allocation, we would have seen that throughout the 2020 on a map like this, XLK would be blue relative to the S&P. There'd be plenty of sectors, plenty of sectors, right, and plenty of sectors that would have been in a relative no-go, you know, to the S&P as a whole. So if you're in the 4 sectors that were blue through 2020 on a relative basis, you're generating alpha rather than just being invested in the equity markets. You know, diversify maybe across the 10 sectors, but if you can be buying the sectors that are in a relative go trend, then that's when you're really generating that alpha.
Trending and outperforming. And yeah, it makes sense, right? We always know in hindsight, in reaction to the COVID pandemic, industrials, materials, folks couldn't get to their jobs. So of course, those took a sharp hit. I don't know if you all follow soccer, or as Alex calls it, football. But John Henry is the owner of Liverpool. Is that right? Also the Red Sox. Great trend following investor, managed the endowment for Boston College for many, many years. But his whole concept, and many trend following investors say that if you could take the emotion, the would be's or the could be's or the should be's out of your equation, and you look at what is, if you just look at what the market is telling you and you quantify that, you have a big advantage over most other human beings who are reacting to the news, who got sucked into crypto schemes with their friends, and they don't really know what they're looking at. They're not using any sort of probabilities or statistics behind their work. They're listening to a Wall Street Bets chat group, right? That is the whole idea behind GoNoGo Charts and behind all of technical analysis, is that we want to be responsible risk managers. We don't want to miss out on opportunities on behalf of our firm, our clients, or ourselves. And so we need to blend these tools to keep price at the forefront so that we're not missing out on what is most important. And that's, if there's one takeaway from today, that's what I hope everybody is putting into their notebooks. But let's talk a little bit more about the other pieces that are in GoNoGo Charts. We talked about the GoNoGo trend, those colors, blue and aqua bullish, pink and purple sensitivities around bearish. And then, of course, we've also talked about the oscillator and volume at the beginning. And Alex, why don't you take us through these next couple slides quickly?
Let's roll through this pretty quickly, but the obvious next step for GoNoGo Charts was to apply the same idea to a suite of momentum inputs that I'd found valuable over the years and got really accustomed to drawing value from, and blending them into one oscillator so that I could get then a complete technical view of trend and momentum on any asset, any security, any time frame. So the idea then was the same exact thing, and you see this all the time. Everybody has RSI, they have stochastics, they have Bollinger Bands, they might have Williams percentile, they might have the awesome oscillator, the alligator indicator, right? There's any number of these, any number of the 200 or so that are on every charting platform.
Yeah.
And I think you also said analysis paralysis, right? We could have the same thing for indicators, but there are some 3 or 4 or whatever that you find really valuable and are important to you. Like I have, friends or colleagues in the who run technical analysis at Nomura Securities, and they will start to really incorporate a couple of momentum ideas into their analysis because they understand what it's telling them.
Mm-hmm.
So the same idea applied to momentum. Take short, long-term momentum, oversold versus overbought ideas, and blend it into one indicator. So we now have multiple inputs going into one indicator that gives us an idea of momentum. But the real quick, and I'll try to just highlight this, you can still do normal oscillator analysis. You can look for extremes of overbought and oversold, right? Where the oscillator is at 5 or 6, you're going to say that's overbought, oversold, and we understand what that means. And then you can also do divergence, momentum divergence, price making higher highs, oscillator making lower highs. Gives you a little bit of a pause for concern because you'd like to see those highs confirming price.
One more quick story on that, Alex. The way that Ralph Acapora taught me about momentum, he just said, Tyler, if you threw a baseball in the air, the speed at which it leaves your glove is going to be fastest. And when it starts to get to that apex, it's slowing down before it returns back to Earth, that gravity acting. So momentum acts the same way. When we have these levels of extreme overbought, that's wonderful. That's not an automatic sell signal. But you see the divergence on the chart in front of you, that's where momentum has not confirmed the price move, where momentum has decelerated and we're looking to come back down. I love the way that he paints a picture for those lessons.
Yeah, another one that always resonates with students is the idea of a car accelerating. And I try to draw a race car when I teach for these classes, which really never goes well. But the idea is that even if the car is accelerating or increasing in speed, it's accelerating more slowly.
Yeah.
So it might be going from 10 miles to 20 miles an hour to 30 miles an hour, and then it goes to 35. It's still getting faster, but it's not getting faster as quickly as it was before. So price is still going higher, still getting higher, but it's not increasing. It's not gaining as quickly as it was before, or as much as it was before. So momentum, very powerful idea. then we talked a little bit about that idea of, this is the same slide as earlier, that idea of oscillators in a trend. And this is where we try to incorporate this piece of research and study into the GoNoGo oscillator. So instead of having to find subjective levels where the oscillator finds support or ranges in a trend, the way that we built the GoNoGo oscillator was so that when all of those combined momentum inputs fall into their neutral territory. So if you imagine RSI, 70 is overbought. In a trend, it'll go above 70 and it'll come back. It'll come back into neutral. But remember, it shouldn't go oversold. That would be a bit off because it shouldn't swing like that. So when RSI is in neutral territory and all of the other inputs that are in the GoNoGo oscillator is told to fall to the zero line. So then what you have in a trend is a very objective level that can be used as support and resistance. The interaction with the zero line becomes very powerful for position sizing, scaling into positions, all the rest of it. It indicates trend continuation because what you're able to say, every time the oscillator finds support and bounces off zero, you're able to say that momentum has come back in the direction of the trend. So you've had that overbought and that cool off, and now you're seeing those signs of overbuying again. You're seeing momentum come back in the direction of the trend, and that allows you to stay in the trend, which is one of the big problems that we have in investing.
So talking with a lot of institutional portfolio managers and really everybody in this business, they talk about it as a lifetime of regret. That you buy a security and it shoots to the moon, you wish you had bought more. Or you buy a security and it falls through the floor, you wish you had never touched it. Now, for most money managers who are looking to really lean into something that's working to help amplify their outperformance against a benchmark or just really generate more returns, they're concentrating their position, they're adding to their position size as the trend continues. So taking that concept of trend following and growing your position size, you think about the resurgence of momentum in trend as a signal to add to your position. Now, that period of cooling off, that's your time where, well, maybe this is the beginning of something rolling over, right? So again, we're going back to the trend checklist. You're back in the airplane. What are you looking for to say, is this about to fail? How will I know when it's time to exit? Well, with GoNoGo Charts, you have the color of the price chart itself, the GoNoGo trend indicator. You've got this oscillator that's giving you a higher conviction, a confirmation of adding to a position. And then, of course, because it's 2021, why wouldn't we simplify all of that? So Alex, the little icons that appear above the price bars, let's talk through those first in terms of the trend continuation. We'll stick with that theme.
Yep. So rather than have to draw your eyes down to the oscillator and train yourself to look for that zero line and wait for the bounce, we just throw those on the chart underneath the price bar. So every time the oscillator finds support at the zero line and rallies, then you're going to get a green circle under price. So actually, we could simplify this chart even further, and sometimes I do this if I'm really trying to do a sort of a demonstration of annotations. You could even concentrate on the price panel, because the information in that price panel is also being driven now by the oscillator. So those green icons are alerting you to the fact that you're getting renewed momentum in the direction of the trend. And if it was a no-go trend, making lower highs and lower lows, they would be red circles above price. Mm-hmm. Not to be confused with these triangles. Now, these triangles are counter-trend corrections. So when you have a go trend in place and you have a normal traditional overbought reading from the GoNoGo oscillator, when that cools off, then we'll get, just like RSI crossing below 70, we're throwing that on there as a traditional overbought signal, suggesting then that price may in the short term correct against the trend, or at least consolidate or move sideways, right? Of course, sometimes it doesn't in a really strong trend. Actually, statistically, people have shown that you can buy overbought. You can buy RSI crossing above 70, right? That's actually something that is there as a strategy. But that's what these icons are.
Brilliant. And last but not least, and we don't have to spend too much time on volatility squeezes, but it relates to that oscillator line as well.
This is quick, and you could spend a whole hour talking about Keltner bands and Bollinger Band squeezes and the whole idea of that. But the last piece of the puzzle, I think, for me was to was to put volumes in there, by the way, in the oscillator in the color change. When the oscillator is a darker blue, then that means volume is heavier than on average for a set period. But this is now saying, let's find those areas of reduced volatility. We get this all the time, a rally in price, a consolidation. Imagine it's like the Bollinger Band shrinking or some sort of Keltner squeeze. You find those areas because we know as technicians, or we know from just looking at these charts, that after a period of significantly reduced volatility, a breakout in any direction may be significant. So we try to throw that also on there as a visual. And so for each bar that the oscillator rides the zero line, the squeeze grid climbs to a max, and then it stays there, and we wait and watch whether or not the oscillator can break out of the squeeze. And on all things being equal, we'd expect it to break in the direction of the trend because the trend is in place, all those conditions are met, we're still seeing blue colors. So when we see the flip side, when we see the squeeze being broken to the downside, that's our sort of first aggressive, maybe take money, take profit, understanding that all is not well with this go trend, right? The go trend is there, but we know there shouldn't be any oversold conditions in a go trend in theory. So when that oscillator breaks out of the squeeze to the downside, that's sort of like an early warning kind of thing. So the squeeze can be, take off in the same direction, get you in, or hey, we shouldn't have broken the squeeze in the opposite direction. So that's something to think about as well.
From failed moves come fast moves. So as you see that squeeze building up and we're holding quite steady on price, maybe it's a time to tighten up stops where it's been a prolonged period of volatility. Where it's been a prolonged period of volatility. Maybe that's where you tighten up your stops so that the loss, if it is a failed fast move, is much smaller on that position for you. So with that, Alex, I think it would be really helpful to pause, hear if there's any questions. We got about a dozen people on the line, and I know it's already 5:15, and I'm sure if your life is anything like mine, I'm sure you have other duties to attend to as you get closer to the dinner hour. But did want to mention, if folks would like a copy of these slides, we're happy to share them. You can just send an email to both of us at info@GoNoGoCharts.com. You can also follow us, by all means, on Twitter, LinkedIn, or you can email either Alex or I, Tyler at GoNoGo Charts, Alex at GoNoGoCharts.com. And if there is time, we can talk through a few live examples or answer some questions. But that's up to you, Ryan.
No, you're good. I'd say dive into some questions. And there's been such great information on this that I wish I had known when I had started 10, 15 years ago. Before I went through every single indicator and realized that most of them are garbage. You could have saved me a lot of trouble right here. So I hope people that are new to this, there's some good places to start off of what you guys have shown so far. So no, I'd say go ahead and dive into some real examples. Let's do that.
I think to your point on indicators or AI or anything, what works for a time in any given market is that's great, but it's not going to necessarily hold through the test of time. And if you're managing money on behalf of clients, you want to find things that are really durable, and you want to simplify your process because you just don't have the time to go through 200 indicators on any given charting platform and spend all day looking at the markets. You actually have to be actively managing money in the market. So
and it goes back to that price is paramount quote, where the opinion of the people in the market is price, and that's the simple stuff still does what it does. A breakout to higher highs or support being tested, the simple things really, really work. And some of the most used indicators work, but you can go so far down the rabbit hole that you end up really sort of disillusioned with the whole idea of trying to figure it out, So
absolutely.
I'm just sending a note to everybody. You could drop some ticker symbols for us in the chat or the Q&A function. If you've got questions about the technical tools and the philosophy and the process that's built into these charts, we can do that. Or we could just walk through a few live charts.
We could pull up a couple.
I'd say let's look at a couple cryptos. It's been an interesting day for them today.
It sure has.
Yeah, I would say it has. Let me Let me share my screen. Let me know if you can see my screen now.
Yep.
Sure
Okay,
can.
so that's this is the website, but yeah, let's do a crypto. So, well, why not Bitcoin?
Why not?
This is Bitcoin. I mean, oh my word, right? I remember having this conversation with a really good friend of mine. The last go that was triggered was about 10,000 or 11,000 on Bitcoin. And just real quick, right? One of the strategies that we're finding a lot of success with, and that we're talking to a lot of people that actively manage money, is if you think about, everybody talks about buying the dip or bull flags, or and it really goes back to that idea of seeing momentum come back in your direction, right? That's sort of your low risk entry. And we tried to highlight on those charts, on the charts with those green circles, because often you'll see a go flag, you'll see a trend identified, you'll see a quick rally, and then if you get in a bit late, it'll often come back against you. And that's when we would look to the zero line to see if support is found, if the support is held. And then on a green circle, you could enter the trend in a relatively low risk fashion. And so that's a long way of saying that I was talking to a good friend of mine back on Bitcoin, and let's pretend the chart was more like this. Okay, so we just seen this this go signal here, and we're saying, well, it's a shame really, because you missed the move. It's at 19,000 now, and there was no green circle. It never came back. Momentum was just so strong, it just kept going, and momentum never came back. And then, so we were talking about how, sometimes that happens, and hey, but you're trading a little bit of profit for some risk by waiting for that first one. And then, that it sort of played out exactly as often it does with technicals, and the momentum, you got a correction after that really strong move, and then another move happens then. And so then we were laughing about it when we're back up at 60,000, that it would have been okay getting in at 18,000. So just that sort of idea of using all of these things to to stack the odds in your favor a little bit. And again, the trend was in place then all the way through till we started to see the amber bars come in mid-April. And again, it's the same thing. And another thing that Tyler and I talk about a lot with our clients is that idea of you can sort of be in line with market returns, but if you've reduced max drawdowns, then that's a significant win, right? So when you perhaps get out of the Bitcoin in this sort of area, and then it kind of rallies, and you think, well, okay, I maybe I should have kept it, but you aren't suffering from the drawdown, and who knows what will happen now? It might come roaring back to 60,000 within a couple of days. But if you've reduced your client's risk exposure by not suffering from the drawdown, then that's a significant part of technical and of managing money as well. And so we'll see what happens now with Bitcoin. It's come way off the lows here today, but we went down and touched just below 30,000, and we were getting a bunch of these no-goes in here. And again, the interesting thing is that you get that break of the zero line, you understand that this shouldn't be happening, and then we get the color change, and so it's sort of automating that checklist for you by saying, first it crossed below zero, now we don't have a go trend checklist is not being met because we can't paint a blue bar. Now we're in neutral territory. Now we're getting no go trend checklist being fulfilled by painting the pink and purple bars, and you can save hopefully some of the larger down moves from affecting you.
Alex, if you could pull up triple levered NASDAQ, TQQQ. We just had a question from one of the audience members about using these tools on a levered ETF product. And I'm going to venture to guess that it works the exact same way that it would on any other security.
Yeah, it's been choppy, obviously, with the tech. QQQ is tech heavy, but yeah, anything with the data, with a good data series and
liquidity,
it'll do what it's supposed to do. Yeah. I don't know if you wanted to. I know you said cryptocurrencies, Ryan, before, but we were looking a lot at the Ethereum to Bitcoin ratio. So going back to a little bit of that that idea of relative strength, and Bitcoin has been going sideways really and struggling, right, for a while. And we actually wrote about this in one of our research reports about noticing this trend change of Ethereum starting to outperform Bitcoin. And
the higher beta play, right? If Bitcoin is the Procter and Gamble of the cryptocurrencies, then it looked like risk appetite was going, exploring for smaller and more volatile coins. That's you can apply the same concepts of leading, trending, and outperforming to any asset class. So you could look at a commodities index and see that lumber and copper over gold over the last year have been really strong, and now that relationship is changing a little bit.
Yeah, and we've put together custom maps for people that are the 10 largest cryptos by market cap, and you can sort of get that asset allocation idea from the cryptos as well. But then the Ethereum chart was rallying this whole time that Bitcoin was going sideways. So of course today was not the day for any cryptocurrency, but it's just interesting that you can apply the same ideas of relative strength and trend identification to the cryptos, just like you can with anything else.
One thing I would share on cryptos in general, particularly on such a strong no-go day as we've had, when they rallied parabolic off of the Thanksgiving rally 2017, I remember sitting around the Thanksgiving table and Aunt Pam was asking about what is a Bitcoin and should she own some and how would she even go about buying them? And then it cratered, right? In most other examples in history, when you look at a tulip bubble or you look at things that have reached a parabolic move, right? Diapers.com in the late 90s, and a lot of those never recover once they have traded like that. When there is that kind of frenzy, and then you wash out so many of the participants. The durability of blockchain technology seems evident in the charts, considering that we have regained, surpassed, and now traded to exponentially higher all-time highs. So take what you will from that. It doesn't seem to me like this is the end of digital assets. It certainly is a sharp correction, and
just to really hammer the point home, for me, what jumps off this chart is that this is absolutely, to me, insane that this is where price stopped today. Right, so it jumps off the chart to me, and I'm able to see that really, really quickly because I've got my technical perspective and my technical checklist just painted in the colors of the bars. So I can just, that's crazy that there was so much buying, so many buyers waiting at these levels, and it's a horizontal line from previous lows, and the rally off that level, all the way back up to 38,000, but it's right there for you to see because I guess you haven't made the price panel tiny with all of the technical tools that you like to look at.
Yeah. One more question from Don, who was just asking about the data feed. So Don, it depends on which platform you want to use this on. So right now, GoNoGo Charts are on TradingView, Wealth Charts, and we're working with the team over at Stock Charts. Those will be out really in the next month or so, this summer at 2021. And so depending on your data package, if you're choosing real time, then these are all real time during market hours. I think with the free account on TradingView, it's a 15-minute delayed bar, but you can still look at a 5-minute chart. Wouldn't make a lot of sense since your data feed is delayed. But no, it's not just related to end of day data. You can see the bar moving as it's as Bitcoin continues to trade. So this is all live real-time data.
Yeah, and the other also in there, I don't know if that's part of the same question, but of course you can use it on any periodicity. So you could throw a 1 minute. This is a 1 minute chart of Bitcoin. We do actually work with some people that are trading E-minis and things like that using 1 minute charts. So any periodicity, depending on your data feed, will depend on whether it's actually live or not. TradingView, on top of the fact that you have to have you have to have you have to have one of their paid plans to get real-time data, and then you have to pay, I think, $2 per exchange for the data that you want. Some of the bigger platforms, obviously, like Bloomberg and stuff, might pass the data fees, or might absorb those, but it depends on what you're using. Yeah.
Excellent. Ryan, any other questions? I don't want to keep people longer than they want to be here, but
no, I think we're good. I think that was fun. Thanks for being here today, guys. Thanks, Alex. Thanks, Tyler. It's good to see you as always.
Great to see you too, Ryan. Looking forward to seeing everybody from NAME at the conference, either this October in Chicago or next spring, whenever.
Next spring, absolutely. We're doing both live, so yeah. Hope to see you there.
Fantastic.
Yeah.
Thanks so much.
Sorry.
I just said thanks for having us.
Thanks, and thanks everybody for being here today. Coming up next week, we have the Name Exchange on Thursday, May 27th after market hours. And don't forget, we do have, as we were saying, the conference in October. You need to sign up and be there. So that's it.
Ryan, are you going to be there with your bass? Did I bring my drums?
Maybe we could see what happens. I mean, you let me know ahead of time. We could do something.
We can do something.
I want to know who's singing.
Not me.
Susan. No.
Susan's the singer. Perfect.
Nice.
Perfect.
Nice.
All right.
All right. We're good. Thank you for being here. Thanks again, everybody. We'll see you guys next time.
See you soon,
All right.
Ryan.
Thank you.
Bye,
Take
guys.
care.